Hello, and welcome back to Principles of Accounting 1. I'm your host, Dr. B. We are in our fourth week of Principles of Accounting 1 here at UMGC. And a couple of interesting things to note before we jump into this week's content. Let's talk about real quickly where we are, where we were, and where we're going. Okay, so where we are, we're in week 4. This week is hopefully a lot more straightforward than it was last week. This week we have a couple of chapters to cover, a couple learning resources, 10K discussion on key reports and information, homework assignment, report out, and of course your self-assessment. Keys to success for this week: please complete the self-assessment before you jump into the homework assignment. That would for sure put you in a good position when it comes to success on the homework assignment. Let's talk about where we were. We had just finished week 3. In week 3, we had a lot of work, very busy week last week. You had your 10K discussion on the income statement, homework 3, exam 1, an assignment on career exploration, and your week 3 report out. So that was last week. This week is, as I had mentioned, a lot more straightforward, a lot more straight line, very, I don't want to call it a short week because it's not, but it's probably a more simplified week than it was last week. What does that mean? Where are we going? Week 5. Next week, you'll have exam 2 in week 5. That will cover content from weeks 3, 4, and a little bit in week 5. Each exam typically covers about 2 weeks worth of content that you learned in that previous week. So that's kind of where we are with that. So let's go ahead and jump into this week's content. We will be discussing internal controls, current assets, and current liabilities as we continue to discuss our content as we talk about Principles of Accounting 1. So the first thing to note when we talk about internal controls is the Sarbanes-Oxley Act of 2002. What this act did is it provided public assurance that publicly traded companies were being open, honest, and transparent. The reason why this act came about was because of several instances that happened with publicly traded companies, namely Enron and a few other companies who acted unethically in the early, mid, and late 90s. And I'm sure there were plenty before them that acted unethically. So that act was designed to provide internal controls and to safeguard the public, which was the entire crux of the Sarbanes-Oxley Act. And so what it did for investors is to provide open, honest, and transparent view into the financial statements of publicly traded companies. And the idea behind it is to prevent fraud and theft. So that is the Sarbanes-Oxley Act in a nutshell. And you'll notice within your projects that you're doing for this course on the 10K projects, is there's typically a section that says who audited the company, okay? And the auditors are typically one of the big 4 accounting firms. And what they do is they validate the accuracy of the financial statements, which is what auditing is all about. And the idea behind that is to provide that honesty and transparency to stakeholders, investors, the government, so forth and so on. And so that's really the idea behind internal controls, is making sure that information is accurate, the company's abiding by laws and regulations, and that we are safeguarding the company and their assets. That's what it's all about. One serious concern as we deal with internal controls is preventing employee fraud. Employee fraud is the intentional act of deceiving the employer for personal gain. An example of that would be, oh, I punched the time clock, but I didn't actually start working for that first half an hour. That is theft, believe it or not. You stole time. Time is money. So punching in and not doing work for that first half hour, that's considered theft. That's fraud. Whether your employer sees it that way or not, that's another story, but that by legal definition is considered to be fraud. Another example of employee fraud that I've seen employees do is, well, I guess it could also be theft, but one time I had an employee that was working at the bar and the restaurant in the hotel that I managed, witnessed the employee ring up a customer's order as something else of a lower cost, quoted the customer the price of that product that they had originally ordered, and pocketed the difference. Yeah, that's fraud and theft, right? So there's a lot of that type of thing that happens in business, and that it's unfortunate, but it does happen. So how do we prevent fraud from our employees or from pretty much anyone else that interacts with the company? Is through a concept called internal controls. These controls help the institution, the business, to prevent theft or fraud. Internal controls involve controlling the environment, risk assessment, controlling procedures, monitoring, information and communication control. Controlling the environment, that's the natural environment that the business operates within. So controlling the environment would include establishing things like security cameras, security measures, security protocols, as they deal with managing assets like cash or inventory. Risk assessment is identifying internal and external risk factors, such as the potential for employee fraud, external theft, external factors like a virus. Those are all risk assessment factors that businesses go through. Control procedures are procedures established by the company to help the company control their internal processes. What that does is it helps to safeguard information. Hold on just 1 second. Okay. Another component of internal controls is monitoring. Monitoring is not just monitoring with security cameras and things of that nature. It's also monitoring interactions between employees, management. It's monitoring communications. It's monitoring changes in financial reports and statements and things like that. So that's another element of internal control. And then, of course, we have information and communication controls. What that is a set of internal controls for management and employees to deal with the general public, to deal with federal investigators, to deal with X, Y, and Z. The idea behind it is that with information and communication controls, we are managing the way that the company perceives itself to external parties. So those are controls. Any questions on controls? We're okay. We're good? Okay, great. Okay, the next subset of information has to deal with current assets, which is what the bulk of this week is about. Current assets, as you know, are assets that can be utilized within 12 months or less, hence the name current. Current assets, so when you hear the word current in accounting, it means 12 months or less. Current assets include things like cash, accounts receivable, any other type of receivable account, inventory. Let me think. Any other current? It's anything out within that 12-month period. So another one would be investments held for sale, or you'll see it on the 10K report as securities investments. Those are all current assets. And the other idea behind current assets is something that's a current asset means it can be quickly converted into cash. Cash includes things like coins, paper money, cash, checks, money orders. It also, believe it or not, includes the collection of credit card payments made by your customers. When it's a way of thinking about it is when you go to purchase gasoline for your car, you have two options to pay for that gasoline. You can either insert your debit or credit card, or you can pay in cash. And the company treats those debit and credit card payments the same as cash because it is technically a form of cash payment that they are collecting. So when you hear cash, it means cash and cash equivalents. And we'll talk a little bit more about that. Money on deposit with a bank or financial institution that can be withdrawn for any consideration is considered to be cash. Cash is the most likely asset to be stolen, of course, because of how untraceable it is. Traceable, untraceable to some degree. So how do we, the business, control cash or the misuse of cash? How do we prevent it? We do this thing called deposits, receipts. Anytime that cash changes hands within the business, there is typically a paper trail to follow it. When you ring up a sale for the customer and there's cash involved, there is a receipt generated. That receipt is the documentation of the receipt of that cash. When a customer pays you with a check for their accounts receivable and you receive that cash payment in the form of a check, there is a receipt generated. And of course, when you make the deposit into the bank account, there is a receipt generated. So there's a deep paper trail that is involved with cash in most situations, in most situations. So when we receive from cash from a customer, it's typically over the counter and it goes into a cash register. I'm sure you've all seen this type of behavior before. I'm sure you've been either on the sending or receiving side of cash, hopefully. So here is what happens when you go to the cash register and you cash out and you're buying groceries at the grocery store. You're the customer, you pay with cash, you're given a receipt, and you get to take the inventory home with you, right? So a lot of things happen in that transaction that you may not know on the backside of things. When the cash register scanner goes off, it's taking it out of it's taking the items out of inventory. When the cash register sale goes through, there's a receipt generated. That receipt goes to the accounting department. The accounting department enters that as a form of a journal entry. When cash is deposited at the end of the shift, it goes into the cashier's department. Cash deposit goes to the bank. The bank gives the company a deposit ticket. That deposit ticket goes back to the accounting department and shows up on the financial statements. So you can see the never-ending cycle of what happens when there's a cash transaction. Sometimes there's a situation where there's what we call an over or short. What this is when we ring up a sale and we either didn't give the customer enough change back, or meaning we forgot to give them some of their change, or we gave them too much change, right? When it's over, that means we forgot to give the customer their change back. When it's under or short, that means that we gave the customer too much change back, right? And that's what typically causes cash shortages and overages. Employers do not like that, by the way. So when something like that happens, it's usually not good for the employee. Okay, so what is the type of journal entry that we would make in the receipt of cash from sales? And how do we account for the cash shortage or overage? So here's an example of this. At the end of the shift, we collected $35,690 in cash. However, the cash receipts sales totaled $35,668, which means that we failed to collect $22 in cash from our customers. Uh-oh. So how do we document this? What is the transaction? What is the journal entry? Well, we debit cash for the cash that we actually received, $35,668 in this case. We debit cash short and over, $22. That's the difference, right? So in that difference, when you debit the cash short and over account, that means that we are saying, hey, you know what? We're short that amount. When it's a credit, that means we're over. And we'll see an example of that here shortly. And the credit account here is sales. We credited sales to increase sales by $35,690. So debit cash, debit short and over for the difference that we're short, and credit sales. So again, if it's a shortage, it's a debit to the cash short and over account. If it's an over, it's a credit. Let's see here. Typically, when we receive payment from customers through the mail, it's because we have either sold it on account, or the customer is now paying us, or they are there's some type of return involved, or there's something going on, right? Typically, when we receive cash in the mail. Just so you all know that, and hopefully you all know this, never send physical cash in the mail. That's not good. That's very unsafe. Send a check or a money order. Never send actual cash in the mail. I've seen it done a lot before, and it's not safe. Because if that envelope gets lost, I mean, there's nothing you can do. So just throwing that out there. Okay, and so and this happens a lot. So think of a time where you paid a bill through the mail. Well, in today's day and age, it's usually done through the internet, but some of you might still be paying bills through the mail. Once in a great while, I have to do that for whatever reason. So when you paid your bill in the mail, you write out the check, and you usually include this thing called a remittance. The remittance is the end of the bill that shows the account number, the amount, the date, all of that good stuff. And what that's called a remittance. And what that does is it helps to control the cash that you're sending. And so that way, on the receiving side, they know what account to attribute that payment to. Yep, very important to include that. EFTs, which is how most cash is done in today's day and age, is called an electronic funds transfer. It's where cash is changing hands virtually for various things. You know, I pay pretty much all of my bills online. And so when you do that, it's called an EFT, electronic funds transfer. Pretty much everything's online these days. So that's very, very common. It's actually more common than a physical check is in today's day and age. EFTs they cost a lot less to do it than they do through the mail. Obviously, it's a lot faster, and there's a reduction of risk because the employer's not physically handling checks or cash. The control of cash payments should always be reasonable, that payments are made only for authorized transactions and are fast and efficient. Which leads me to our next topic related to cash. It's called a voucher system. A voucher system is where we record the liability in cash payments. It's typically mostly computerized. Yes, of course. Vouchers. When you think of a voucher, it gets treated pretty much the same way that a cash payment does, or it's a promise to pay in some cases. That's what a voucher is. An example I could give of a voucher would be in the hotel business. Once in a while, we would have a customer or a guest arrive by taxi to the hotel because they missed the shuttle van from the airport, or it was after hours or whatever. But in that case, oftentimes the hotel would pay the taxi company for the fare through this thing called a voucher. And what that did is it's basically a promise to pay to the taxi company. It works basically the same way that cash does. These can be also used for various vendors for the purchase of goods. And again, it's essentially a promise to pay that respective vendor. And it's prepared and submitted for approval. And then the way it works is that on the date of that voucher, a check is usually issued for that payment. Everything's computerized. So it's pretty rare these days that we're doing things by hand, especially in accounting. But so the way it typically works is that on the due date, checks are automatically issued for those vouchers. Another thing along these lines, vouchers and EFTs and cash and things like that. I did want to call this one to your attention because this one is very common, and it's something that we'll be looking at a little bit closer. When we talk about electronic payments with the use of cash, you can think of it as a form of like an ATM machine. Also, when we write a paycheck to an employee, it's pretty much as good as cash. The employee can take that payroll check, go to a cash checking check cashing location, whether it be a bank or elsewhere, and that payroll check would be converted to cash. That's why they say a payroll check is as good as cash. Nowadays, typically, direct deposit takes care of that for us, but there are still some instances where employees receive a physical payroll check and will have it cash. The reason why I bring that up is because we will be discussing shortly about bank accounts. And with bank accounts, there is a little bit more on the back end of accounting that we have to do, and it's called bank reconciling. We're going to talk about that here shortly. So businesses always typically, most of the time, 99% of the time, use bank accounts for their transactions. These bank accounts track cash, right? That's the whole idea behind a bank account. It reduces the amount of cash on hand, provides independent recording of cash transactions, and we use it to reconcile our cash account on our balance sheet according to what is actually in the bank. So in that, there is a statement called a bank statement. Hopefully you all know what that is. Every month your bank, if you have a bank account, provides you with a bank statement. And that bank statement shows you a beginning balance, any additions, deductions, and an ending balance. And this is an example of what a bank statement looks like. Hopefully you've all seen one of these before. The idea behind this record is it shows all of the cash transactions, right? And in that, we are able to reconcile our cash account on our balance sheet to what is in that bank statement at the end of each month. So we had talked about this process called the closing process or the adjusting process. And in that adjusting process, closing process, we reconcile our accounts. We make sure that what is in our bank account matches what is in our accounting system. We do that through by looking at our bank statement and matching what transactions have occurred with the cash from our cash account. And of course, the bank statement records a lot of additional information like any type of errors, return checks, service charges, EFT payments, interest earned, proceeds from a loan, things of that nature. And then with those extra components, we make adjusting journal entries. And all of this is done through the reconciliation process. And so what we do is we match our company accounts, our more specifically our cash account on our balance sheet, and we match what's on that balance sheet cash account to what happened with our bank statement. And of course, we make any adjusting journal entries to record things like service charges, NSF charges, bank errors, strange deposits, interest earned, loan proceeds, bank errors, things like that. These are all things that clearly will have an impact on your cash balance. So at the end of each month, we do this thing called reconciliation. A lot of time, you heard me say the term NSF. It means non-sufficient funds. Hopefully that never happened to you, but once in a while it does happen. It's where you wrote a check and there's not enough to cover that check amount. Whoops. A lot of times that happens because the company did not properly understand what their true cash account was. Or they wrote some checks they didn't clear within a certain amount of time, and then all of a sudden they all cleared at once. That's happened before, yeah. And so that's just one of those terms that the bank uses. So sometimes, yeah, there's going to be a difference between the bank statement cash balance and what the company's cash balance is. That happens a lot, and a lot of times it's because there are delays in individuals cashing checks. There are delays in recording transactions. There are fees and interest and all kinds of stuff that happens in between. So what do? We go do this thing called bank reconciling, where we match our bank statement to what is in our company records. So here's an example. On the top part, we see the bank statement. On the bottom part, we see our company cash account that's in our accounting system. We see that there is an imbalance. The ending balance does not match. Well, why is that? Well, we can already see that we have about $2,000 in checks outstanding. Well, not quite that much, but we have about $1,000 in checks outstanding. We have NSF fee of $300. We have bank service charges of $18. And so there's going to clearly be a difference in the ending balances. So in order to make those ending balances match, we do this thing called bank reconciling, where we match the transactions that have happened and we reconcile the account. There are a few ways to go about this process. So the most commonly used method is bank reconciling. And in that method, we first identify two sections. Where the bank section begins, the cash balance, and where it ends, and with the adjusted balance. And then on the company side, begins with a cash balance according to the records of the ending with the adjusted balance. The bank statement and the company balance sheet need to be equal. They need to be equal. And so how do we do that? We do that through the adjusting process. So earlier I had mentioned one of the reasons for a bank statement not matching the accounting record or the balance sheet for cash is typically because we have outstanding checks. Sometimes the company will write a check, but the vendor won't cash it until a later date for whatever reason. And when that happens, clearly it's going to cause a difference between the bank statement and what's in the accounting system. And yeah, that could be kind of frustrating sometimes because you could be off by thousands of dollars. And another reason would be the bank fees and any type of interest earned. And so what we do is we go through the reconciling process to make sure that we have an ending date on our bank statement that matches the ending date on our cash account. And we make sure that those two balances are the same. So there's a couple of steps that we follow to do that. First, we enter the balances in the cash balance according to the bank statement. And we add any deposits. We deduct any outstanding checks that have not yet been paid by the bank or cashed. And we determine the adjusted balance. Then we enter the cash balance according to the company. We add credit memos that have not yet been recorded. We deduct any debit memos that have not yet been recorded and determine the adjusted balance. So once you've gone through those 9 steps, typically what you'll find is the reason why the bank statement never matches what's in the company ledger is because of checks that have not been cashed, fees that have not been entered, or any interest that has not been entered. So at the end of each month, when you get your bank statement, you go into your accounting system, you look at your cash balance in the accounting system, you look at the cash balance on the bank statement, and you start the reconciliation process. So what we did in this example is we identified a deposit that had not yet been recorded on the bank statement of $816.20. We identified outstanding checks, meaning checks that have not yet been cashed, totaling $1,544.99. We identify interest that we have received plus, or not receivable plus interest that we've received from the bank that have not yet, we didn't record it in our ledger. We identify an NSF for a customer. So going through those steps and making those adjustments to the ledger through adjusting journal entries, we're able to then match our cash balance in our accounting system to what is on our bank statement. And that's what those steps represent. Any questions at all on bank reconciling? We're doing okay, right? Right, gentlemen? Dustin, Joe?
Yes, I'm doing all right. Doing great. I understand this portion of it.
Great. I'm happy. I know sometimes that this part can be a little confusing because a lot of times both individuals and businesses don't always do this process, to be honest. One time I did some consulting work with a company that was doing some contracting with the federal government. And I looked at their accounting records, and I'm like, well, why do you guys wait until the end of the year to make all these adjustments? You should be doing it every month. And they said the reason was, oh, well, we just don't have the time to do it. And I said, well, what happens when you realize that somebody didn't cash a check and it's just sitting out there, and then all of a sudden you have your shareholders, your government, you have somebody to answer to. So that's why this process is really important for both individuals and companies to understand.
Well, yeah, actually, side note, you'd be surprised on how often the financials in the government gets messed up because of human error.
Yeah, you're 100% right, Dustin. And a lot of times, what we see is those errors could have been prevented if they would do this type of thing. You know what I mean? Or at least, or it could be caught early on, so that way it could be corrected. So but yeah, that happens a lot. Okay, so here's another example in the reconciliation process for our company. We receive cash from a note receivable, but have not yet recorded that transaction. So on July 31st, we make the adjusting entry. We debit cash $408, credit note receivable $400, and credit interest revenue $8 to represent the receipt of a note receivable. Now you may be asking yourself, or you may be asking me, Dr. B, what's a note receivable? That's different from an account receivable. So a note receivable, and I'm sure you probably read about this already, but just to kind of recap, a note receivable is when we, the company, have converted a customer's account receivable into a note. A note is a loan, right? And a note represents a promissory note that the customer agrees to with some additional interest. Why does that happen? You might be wondering. Sometimes a customer doesn't pay, right? Once in a while, or they forgot, or whatever reason they didn't pay us on time. So what typically happens is that the company will contact the customer, say, hey, customer, you didn't pay us. You have this outstanding account. We need to set up terms with you in order to receive payment. So what we typically do is we convert the accounts receivable into a note receivable. And with that, we apply interest. So we'll say, okay, customer, you haven't paid us in, X number of months. We'll convert your account receivable to a note receivable. You'll still owe us the principal balance that you originally owed us plus interest. And that's usually outlined in this thing called a promissory note. It's agreement between the company and the customer. And also, another journal entry that we made was debit to accounts receivable from a customer that they had paid us. I'm sorry, no, this one is the bounce check. A customer tried to pay us, but the customer didn't have enough funds in their account to pay us. And so the company incurred a non-sufficient fee. So what do? Well, we debit accounts receivable for that fee for that customer. We debit a miscellaneous expense for whatever reason. I don't know what that one was. We debit accounts payable for a different customer for whatever reason. And we credit cash to represent the changes as a result of various fees from the bank that were on our on our bank statement. So yeah, bank reconciling can be a daunting task to some accountants. Accountants don't necessarily like doing bank reconciling because it's kind of a grueling task. It can be anyway, especially if there's a lot of transactions. But it is something that should be done on a regular basis to ensure accuracy in the financial statements, and especially on that cash line. Especially for small businesses, it's very, very important to make sure that you understand how much cash you actually have on hand that matches your financial statements. Okay, so that kind of leads us to this next topic called petty cash. Petty cash, I hate petty cash. I really do. It's but it's sometimes just necessary. We used to have a petty cash fund at the hotel. A petty cash fund, what it is it's a small amount of cash for miscellaneous things that you just don't have time to write a check for. Okay. An example. So at the hotel, we would have a petty cash fund of like $300, and we would a month, right? And we would use that cash for things like postage stamps, office supplies, minor repairs, various special events that we needed cash for, because so the accounting office isn't open 24 hours a day. We typically did a 9 to 5, like most back end offices do, 9 to 5 Monday through Friday. So what do you do when the accounting office isn't open and you need to buy postage for the front desk? We go down to the post office with cash. Where'd you get the cash from? The petty cash fund. Petty cash fund is designed for that reason. So how does it work? Well, to establish a petty cash fund, the accounting department writes a check to petty cash. Well, basically, all you're doing is you're crediting cash and you're debiting your petty cash fund and you're crediting cash. Essentially what you're doing is you're moving one asset account to another asset account. It's still cash, it's just a different purpose for that cash. And you use those funds for various reasons, typically small in nature, obscure in nature, but you need to make sure that when cash comes out of the petty cash fund, that there is a receipt associated with that disbursement. So for example, let's say I'm working at the front desk and I need to go get stamps from the post office. I go get stamps from the post office using petty cash from the front desk. The post office gives me a receipt for the purchase of those stamps. I put that receipt into the petty cash drawer. What that does is it creates a paper trail for the use of the petty cash fund. So at the end of the month, when we run out of petty cash, we bring all those receipts to the accounting department. The accounting department creates a special journal entry or an adjusting journal entry to account for the use of that petty cash. And then the cycle repeats itself. The accounting office then writes another check for petty cash and the whole thing starts over again. Very, very common practice in businesses that are typically involved in events, or the restaurant industry uses it. A lot of service industry businesses use this concept of petty cash, and I'm sure there probably are some government agencies that use it as well. But but again, it's something that should be used sparingly. To establish a petty cash fund, you debit petty cash and you credit cash to establish that petty cash fund. As it's being used, your receipts are entered as expenses and they draw down on that petty cash fund. So here is an example. At the end of that month, when we draw down our petty cash fund, we make a general journal entry, also known as an adjusting entry. We debit the uses, the expenses, office supplies expense, store supplies expense, miscellaneous expense, and we and of course we credit the cash fund, right? And what that does, it represents the use of that petty cash. And then of course we go back through and repeat the process. So now that we have an understanding of the uses of cash, let's look at how do we analyze the cash, right? Oftentimes businesses need to understand how much cash they have on hand to survive. That's a pretty typical type of calculation. Got to make sure how much cash we got on hand to survive. This measure is called days cash on hand. Basically tells me how long I can survive if there were to be a significant decline in revenue generation. In other words, if I stop selling, how much cash do I have to survive? And the way to figure that out is you calculate days cash on hand. It tells you how long you can survive, how many days you can survive on the cash that you have left. So in that calculation, we take cash and any short-term investments on the balance sheet divided by daily cash operating expenses. Or you're probably wondering, how do you calculate daily cash operating expenses? It's very straightforward. Take your operating expenses minus depreciation expense divided by 365 days. That gives your daily cash operating expenses. And that simple calculation, that simple ratio tells you how many days of cash you have on hand to survive. So it's basically a liquidity measure. So here's an example. Year 3 cash on hand at the end of the year, we have $6,328. Short-term investments of $3,770. Operating expenses were $8,656. Our depreciation expense for the year was $1,490. So we take our cash plus short-term cash investment for year 3 was $10,098. Our daily operating expense for year 3 was 19.6. How do we get that? You took your operating expense minus depreciation expense divided by 365 days to get a cash on hand, days cash on hand of 515 days, 515.2 days. And what that tells us is that I can survive 515.2 days with our existing cash on hand. Especially it's what we call a liquidity type of ratio. Liquidity, as you know, determines the viability of a company, right? What's their ability to pay short-term debts? How long can they survive, essentially? Okay, so that's cash. Any questions at all on cash before we jump into receivables?
No, sir.
Great, awesome. Thank you so much. Let's go ahead and jump into receivables. Receivables is a claim against another entity. There are a couple different types of receivables. You have accounts receivable, which, as you know, are generated from sales that you have made to customers on account. The term on account is a promise that the customer will pay you at some point in the future for the purchase of goods or services. Sometimes those are called trade receivables. Depends on the type of business, right? Another type of a receivable is called a notes receivable. Notes receivable are, as I had mentioned earlier, are basically the conversion of an accounts receivable into a note. A note is a loan. An accounts receivable is a transaction that you made on account with a customer. The customer said, well, I'll pay you later. A note receivable means that customer never paid you later, so then you converted their account receivable into a note receivable. Note receivable simply is an account receivable with interest. It's a very simple way of looking at it, I guess. We'll dive a little bit deeper. So yeah, accounts receivable, very, very common. They're typically collected within short time frames, 30 or 60 days. It's typically always 30 days, sometimes 60, depends on the agreement with the customer. Accounts receivable, they're short term, they're on the balance sheet, they're otherwise known as a current asset because you expect to collect your accounts receivable within 12 months or less. Notes receivable are customers that have a formal instrument, also known as a loan with your customer. That a note is a loan. That's what a note is in accounting. Note is a loan. So basically what happens is the customer never paid you on their account receivable. You made an agreement with them. You converted their account receivable into a note or a loan. The customer promises to pay you within that 1 year. And it is governed by this thing called a, what the heck is this? It's governed by what did I call it earlier? What's that document that you, a promissory note, promissory note. A note receivable is governed by a promissory note with a promise to pay in the future. What is that? Okay, anyway, other types of receivables include things like interest receivable, that's interest that you would gain on a bank account. Taxes receivable, rarely happens. No, well, no, there's a few different types of tax receivable. I take that back. One type of tax receivable would be generated from an overpayment that you made to the IRS for your taxes, and all of a sudden the IRS owes you money. Yeah, I know, right? Yeah, that's a nice dream. But another type of tax receivable would be something like sales tax receivable. Sales tax receivable is generated when you made a sale on account and there was sales tax involved with that sale. So when the customer pays you, they're paying you what they owed you from the purchase plus any associated sales tax. And then, of course, you, the business, remit that sales tax to the respective government entities. And of course, there's other receivables from officers or employees. That's very not typical. Some businesses do it. Basically, what that is the company lent money to the employees or officers. Happens from time to time. I personally don't like when the companies do that, but it does happen from time to time. I've seen it, and it's just not fun. Other receivables, they're separate on the balance sheet, or otherwise expected to be classified current assets or investments. So when you sell on account, accounts receivable, right? When you sell an account on accounts receivable, sometimes the customer don't pay you. That's not cool. You know, sometimes they duck out on the bill, or they'll try to duck out on you. They won't pay you. Yeah, I mean, you know, that's unfortunately that's to be expected sometimes when you're a large company. So what do we call that? We call that an uncollectible account. Uncollectible account. Yeah, it's not fun when that happens. You know, it's you send the bill to the customer, say, okay, pay me in 30 days. Guess what? They don't pay you in 30 days. Okay, now you're 30 days past due. Now you're 60 days past due. Now you're 90 days past due. Now you're 120 days past due. Now you're 180 days past due. Usually when you get into that 60 to 90 range, or 90 and above, yeah, you're not going to be able to collect that money. It's less likely that you'll collect from that customer. The older the aging report gets, the older that account receivable gets, the more likely it is you're not going to collect it. So there's a couple of methods that are a couple of mitigation strategies that companies have at their disposal. One is that they can shift the risk to another company. You may have heard this where they call them, what do they call it? Collectors, right? Collection agencies. A collection agency exists because companies sell their uncollectible debt to a collection agency, usually for a lesser amount. So, for example, let's say Joe owed my company $100 for a sale that I made to Joe, and Joe decided, hey, I'm not going to pay him. So, okay, so I issued Joe the first notice, second notice, third notice. Then I sent it to collections. So now Joe no longer owes the company the $100. He owes the debt collector $100 or the collection agency, right? And so when the company sold Joe's account to a collection agency, that collection agency probably only paid that company maybe $20 on the 100 that it was owed. And that's how business works sometimes. They're just shifting that risk, shifting the risk. It's called selling the receivable. Sometimes it happens. Another mitigation strategy that companies had is called a write-off. We can write off uncollectible accounts to this other account called bad debt expense. So what we do is we debit the receivable and we credit bad debt expense. So we're shifting it from a current asset to an expense. When the company writes off a collectible to bad debt expense, we're reducing the current asset, and we're increasing our expense. The reason why companies might opt to do that is because the company can write off the bad debt expense in their taxes, right? So that's one strategy behind it. And also what that does is when you write off an account receivable to a bad debt expense, you're reducing your taxable income, right? Because you're increasing expenses, which means you're decreasing your net income. So you're reducing taxable income in that case. When do we have an idea of when something might be uncollectible? When it goes severely past due, obviously. Customer stops responding to the company's attempts. Customer files for bankruptcy. The customer business closes. The company cannot locate the customer. Various reasons, right? So there's two methods to writing it off, as we talked about with a bad debt expense. There's two write-off methods, commonly used, I'll say. The first one is called a direct write-off method. That's where we straight up reduce the account receivable by debiting account receivable and credit bad debt expense. That's called the direct write-off method. Very straightforward, very easy, most commonly used by small to medium-sized companies. Absolutely, it's the easiest. The other method, which is sometimes a pain in the butt to figure out, is called the allowance method. You have probably also heard this term. It's called the allowance for doubtful accounts. This is part of the allowance method. The allowance for doubtful accounts. Well, anytime you hear doubtful account, it's probably related to the allowance method. And what this does is that we record that bad debt expense still, but we do it in a different way. We do it by estimating the amount we expect not to be able to collect. So in other words, if my company says, you know what, out of all of our accounts receivable, there's a good chance we won't be able to collect about 3% of it because the customer might go out of business, the customer might fall off the face of the planet, whatever, right? And so in that case, we do this thing called the allowance method. We say, whatever our receivable is for that year, we're going to say 3% of that, we're going to reduce it, and we're going to put it in bad debt expense. Now, this is very common with large companies. I know that Macy's does it. I know that Amazon does it. I know that a bunch of large entities do it. And again, the reason for it is because there's a reasonable expectation that a certain percentage of your customers will not pay you. And so you use the allowance method. So let's take a look at an example, a couple of examples, I guess. This first one's the direct write-off method, the easiest one. Our customer, DL Ross, he ain't going to pay us. Ross ain't going to pay us. So what do? We debit bad debt expense and we credit DL Ross's account receivable. What that does is it increased bad debt expense, decreases the receivable. Okay, great. There's a chance he might pay us later, but we haven't been able to find him. So we do the direct write-off method. Then all of a sudden, our customer shows up. It's like almost 6 months later, but he showed up. Okay. So I'm like, great. Ross, where you been, man? I've been trying to collect from you since May 10th. It's now November 21st. So he finally pays us. So we reinstate his account. It's very simple to do that. You just reverse the entry. Debit accounts receivable for Ross and credit bad debt expense to reduce the expense. And then the second transaction is you debit cash because you got cash from your customer and you credit the account receivable, reduce the receivable. So that happens from time to time. You might have to reverse the transaction. It's very simple. You just reverse the accounts, make the adjusting journal entry. Okay, that's the easy method. Now for the not so easy method. This is the allowance method. Under the allowance method, this is where we estimate that a certain percentage of our customers will not pay us. So in this example, we've estimated that we have an account receivable balance of $200,000 at the end of the year. We estimate that, hey, you know what? Out of that 200,000, 30,000, there's not, we're just not going to be able to collect it. So what do? We debit bad debt expense, 30,000, and credit allowance for doubtful accounts. This is an uncollectible accounts estimate. There's an effect when we do that. There's an effect on the net realizable value of our receivables. There's an effect. Okay. So, clearly, when I do any type of write-off, whether it be a direct write-off or an allowance method write-off, when that happens, you're clearly reducing your current assets. And that is going to have an effect on the value of the company and of the assets overall. So we call this net realizable value. To find net realizable value, you take your accounts receivable minus your allowance for doubtful accounts. And that will give you the net realizable value. In this case, it's 170,000 net realizable value. Okay. So let's roll through a couple of more examples. January 21, our customer, we wrote off their account because, hey, they're not going to pay us. So how do we write off their account? We debit allowance for doubtful accounts and we credit accounts receivable to reduce the receivable. The reason why allowance for doubtful accounts, because it's based on an estimate, and when we finally determine that we won't be able to collect it, we debit allowance for doubtful accounts and credit that respective receivable. It's a nice visual representation of that. Okay, during the second year of operations, oh boy, I think there's more write-offs happening. During the second year, company writes off $26,750. This includes the $6,000 from our customer from earlier, and a second customer, or that customer paid us a little bit, or another bill went lapsed for $3,900. So to find the balance for lawful for doubtful accounts, we started with 30,000. That was our estimate. We wrote off 26,750 throughout the year, leaving us a ending balance of 3,250. And that 3,250 is at the end of that respective year. That's the balance that we have not written off, and it's left in the allowance for doubtful accounts. If we had written off 32,100 in the accounts receivable during the second year, the allowance for doubtful accounts would have a debit balance. Of course, it would have a debit balance because it would be negative. Okay. This is a good example. Okay, we got another customer. We wrote off a customer account, and then all of a sudden they showed up, right? Which, again, this happens once in a while. So we wrote them off earlier in the year because we expected they weren't going to pay us. We did that on April 2nd. All of a sudden they show up on June 10th with a check. So we debit the account receivable to increase it. We decrease our allowance for doubtful accounts by that same amount. We debit cash because the customer finally paid us, and we credit the account receivable for that customer. Again, it's kind of like just reversing what you had done earlier. What that does is it adjusts for that allowance, reflecting that change. So when you estimate, how do you figure out how much you're not going to be able to collect through the estimated allowance method? When you estimate, we typically do it either off a percentage of sales or an analysis of the receivables. Percentage of sales meaning, well, I sold $1 million worth of sales throughout the year. I'm going to estimate that I can't collect 3% of that, so I won't be able to collect 30,000. Okay, cool. That's one method. That's percentage of sales. Very easy to compute. The other method, not as easy to compute, is called the analysis of receivables. So let's take a deeper look at both. So the first one we'll look at is the percentage of sales. Very, very straightforward. Here's our data. Balance of accounts receivable, 240,000. Balance of allowance for doubtful accounts, 3,250. Total credit sales, 3 million. The bad debt as a percentage of credit sales is 0.34%. So in other words, we're saying, we made a total of 3 million in sales in terms of credit sales. We're not going to be able to collect 0.34% of that. Or you might be wondering, why credit sales? Well, I clearly already collected the cash sales, right? So yeah, we use credit sales, not total sales. It's based off of credit sales. So credit sales, meaning sales I made on account, $3 million. I won't be able to collect 0.34% of that. So how do we figure out what the bad debt expense should be? The estimate, right? So we take $3 million credit sales times 0.34%, gets us 22,500. and that is our estimated amount that we won't be able to collect. So that general journal entry looks like this. Debit bad debt expense, 22,500. Credit allowance for doubtful accounts, 22,500. And your note is uncollectible accounts estimate. Always got to have your notes, especially for those. Anytime you write a journal entry like that, that is a adjusting journal entry, should always have a note. The note is reflective of what that transaction means or what happened. It just helps for reporting purposes and tracking things. Okay, so 22,500 was the adjusting entry, the estimated uncollectible accounts. Some things happened throughout the year after we made that adjusting entry. Allowance for doubtful accounts ends up having 25,750 because we were unable to collect an additional 3,250 throughout the year. Ooh, man, that's not good when that happens, right? So, and in business, it's really important that we understand how to interpret these financial statements. And one of the best ways to do that is to compute a couple of quick ratios. These ratios save us a ton of time. They tell us a lot of things about the company. So we analyze our information. I showed you a couple with cash. Now I'll show you a few ratios for accounts receivable. And basically what these ratios do is they tell us what the collectability is. And before we do that, of course I want to talk to you about the analysis of the receivables, which is the other method for estimating our uncollectible, our allowance for doubtful accounts, using the analysis of receivables method. So there's a couple of steps here, as you can see. The idea behind it is that the older the receivable gets, the less likely it is to receive it. So 1 through 30 past due, you'll probably be able to collect 90% of those. 31 through 60, you might be able to collect 50% of those. 61 through 90, you might be able to collect 30% of those. 91 plus, you might be able to collect 5% of those, so forth and so on. So, how do we figure out where things are or how old the receivables are getting? We do that through this report called the aging of receivables. And it's a summary that shows us how old the individual receivable accounts are. So here we have, in this example, we have 18 customers on this list. We have it in steps 1 through 3, as you can see here. We have 18 customers, starting with Ash Point Company, ending with Saxon Woods Company. It's 18 customers, okay? And those 18 customers, they all have a balance. Those 18 customers, we can identify when it's not yet past due. It's in that initial due within, right? And then it gets old. 1 through 30 past due, 31 through 60 past due, 61 through 90 past due, 91 through 180 past due, 81 through 365 past due, over a year past due. Okay, now we start to figure out, after you figure out the totals of each column, let's figure out what's the percentage that we won't be able to collect. And usually this percentage is something determined by the company. There's not necessarily like a right or wrong way to do this. but you can kind of get a gauge based off of what you've already collected based on the total. Okay. So we can see not past due yet. 125,000 remaining out of 240,000. Company estimated that won't be able to collect about 2% of that. That's a pretty fair estimate. 31 through 30. Okay, so it's 1 day through 30 days past due. We won't be able to collect 5% of the 64,000. 31 through 60. I won't be able to collect 10% of that 13,100. 61 through 90. I won't be able to collect 20,000. 20% of that 8,900 balance. 91 through 180. I won't be able to collect 30% of that $5,000. 181 through a year, I won't be able to collect 50% of that $10,000 balance. Over a year, I won't be able to collect 80% of that $14,000 balance. And this is what attributes the estimation of our uncollectible accounts using the aging method. So we calculate those types of things, again, based off of expectations, based off of the percentage that we expect not to receive as things get older. It's obvious that the older the collectible gets, the less likely it is that you'll receive it. And just as we did before, once you've figured out how much you're not going to be able to collect based off of that method, you make an adjusting journal entry. You debit bad debt expense and credit allowance for doubtful accounts. And that's the journal entry that you would make. So, and we can see differences between the different methods and the effect on those, but you can see how they're similar. Obviously, you still debit bad debt expense and you still credit allowance for doubtful accounts regardless of the method that you used. But of course, those amounts are going to be different based off of the method that you use. So in that type of comparison, here's another example. Here's some data that we have. A couple of transactions. We wrote off an account. We received partial payment from another customer. Received payment from another customer. We wrote off a couple of other accounts, so forth and so on. So as these transactions happen, we wrote them off. And we expect that out of the $3.4 million in credit sales, we won't be able to collect 1.25% of that. So running the two methods side by side, we can see how they're similar and where they're different. And oftentimes where they're different is going to be in that adjusting entry made at the end. Of course, they both have their advantages and disadvantages, who uses them, why they're used. But overall, usually when a company selects one or the other, they usually stick with it, especially since it usually has to be disclosed in the financial statements. Notes receivable, as I mentioned earlier, it's typically done when a customer who owed us over time, we converted their account receivable into a note receivable because they owed us over time. And it usually involves a promissory note where the customer agrees to pay us in addition to interest usually. So the journal entry that we would make in order to convert a customer's account receivable into a note receivable is we debit note receivable and we credit account receivable for that customer. In this example, we have a promissory note accompanying this note receivable. Customer promised to pay us within 30 days, and attach an interest rate of 12% based off of their outstanding balance. So the customer 30 days later decides to actually pay us. We debit cash 6,060. Why 6,060? Because of that 12% interest over 30 days. To calculate that, you take the principal amount times the interest rate times the number of days divided by 360, giving you $60, which is the interest amount. So 6,060. We credit note receivable 6,000, which is the principal balance, and we credit interest revenue to represent the interest that we received. Sometimes, and this is terrible when this happens, sometimes even after we converted the customer's account receivable into a note receivable, they still decide not to pay us. That's called a dishonored note receivable. It's dishonored for the obvious reason, right? And so sometimes that happens, and what do? We send it back to account receivable. And to do that transaction, we debit account receivable, the principal plus interest. We credit note receivable to reduce that, and we credit interest revenue. And of course, that should, in accordance with a matching principle, that should always be done during the same accounting period. Here's another transaction example. We converted a customer's account receivable into a note receivable, $4,000. First transaction, debit note receivable, credit account receivable, and we account for the interest. In this case, it's over 90 days. So at the end of each 30-day period, it looks like what, $40. So debit interest receivable $40, credit interest revenue $40 to represent the accrued interest. Over time, since it's 90 days, $40 a month, 90 days represents an additional 80. The customer finally pays us the balance, the principal plus interest. Debit cash 4,120. Credit note receivable, the principal amount of 4,000. Credit interest receivable $40. Credit interest revenue $80 to represent the receipt of the full interest amount. Okay, so earlier I had mentioned that it's important for companies to analyze their accounts receivable to understand basically how quickly they can turn that accounts receivable. We call this accounts receivable turnover. Essentially, what it does is it measured how quickly I can convert my accounts receivable into cash. It's done through a ratio. The ratio is sales, or total sales, divided by average account receivable. How do we find average account receivable? Average account receivable is you take your total account receivable divided by 365 days. It's your average account receivable. Another type of ratio would be average number of days in account receivable. What this does is it tells us the average number of days that your total accounts receivable has existed. In other words, how long does it remain in accounts receivable? This ratio is average account receivable divided by average daily sales. Again, how do you find the average? Well, you take the total amount divided by 365. It's your average. When a company, okay, so that's receivables. Any questions on receivables? Any type of receivables? Or okay.
I'm okay. Thank you.
Great, wonderful. Okay, so let's jump into current liabilities. So as you know, receivables, cash, those are all current assets. We talked about current assets. Now we should probably talk about current liabilities. Current liabilities, as you know, is any or liabilities. Well, first of all, assets is anything the company owns. Asset is what the company owns. Liabilities is anything the company owes. Liabilities is anything the company owes. So anytime the company has a debt, it's a liability. Anytime the company owes somebody else money, it's a liability. Current liabilities are liabilities that the company owes to others within 12 months or less. That's what makes it current. 12 months or more is long term. Accounts payable. Accounts payable, as you know, is when the company makes a purchase on account. That's accounts payable. Or when the company receives a bill but has not yet paid it. That's an accounts payable. We call this an accrued liability. It's when it's a promise to pay in the future. Accruals. Accruals is when an accrued liability is when we have made a promise to pay in the future. An example of that. We have an employee. The employee works 2 weeks and gets paid for every 2 weeks worked. Obviously, I don't pay my employee every day. I don't pay them for every hour. Like I'm like, oh, you worked another hour. Here's another $15. Oh, you worked another hour. Here's another 15. No, that's silly. I'd have so many checks flying out the door. I wouldn't know what to do. So I pay my employee every 2 weeks. So the liability accrues over that 2 weeks. The employee worked 40 hours the first week. I owe them $15 per hour. That amount is accrued. They work another week, 40 hours, $15 an hour. That amount's also accrued. It comes out of my accrual when I pay them. So in other words, I'm adding to my wages payable, which is an accrual liability, and then I reduce that when I pay them. It works very similar to accounts payable, wages payable, very similar. Another form of a payable is a note. A note is a loan, as I had said earlier. Sometimes a company takes out a loan. Some of them can be what we call short-term. A short-term note is a loan that I expect to pay within 12 months or less. Typically, this is done when I make large purchases for inventory. And I don't have the funds right away to pay for all that inventory within 30 days. So I work out a deal with my supplier and say, hey, supplier, I'll purchase all this bulk inventory and I'll pay you over time through a loan, notes payable. So here's an example. My supplier says, hey, listen, I'll give you that $1,000 worth of inventory. But I expect you to pay me within 90 days at 12% interest. That's steep, right? But yeah, okay, great. Yeah, no problem. So we record the transaction. Debit accounts payable. To reduce the payable, we credit notes payable to convert the account payable into a note payable. That's what that first transaction is. The second transaction is when I go to pay my vendor. 12% interest, 90 days, looking at $30. So I debit my note payable, the original 1,000. I debit interest expense because now I'm paying $30 in interest on that short-term note payable. And I credit cash to reduce my cash by $1,030. So it's very similar, it's very similar to what we did with our customer. The difference is now it's us doing it. It's companies can borrow money from banks. They can borrow money as a line of credit from their vendors. There's a number of different ways to raise capital. Most commonly, businesses will raise capital by taking on a short-term loan from the bank. So here's an example of that. Company took out a loan from the bank, $4,000. It's a 90-day loan, 15% interest. Oh my goodness, I know what bank this is. I'll stay away from that bank. Okay, so I debit cash because I took out a loan from the bank. Bank gave me cash. I put the cash in my account, $4,000. So debit cash to increase cash, debit notes payable to increase notes payable, $4,000. 15% note, 90 days. 90 days goes by. Got to pay the bank. So debit notes payable, 4,000. Debit interest expense, $150. That's 15% over 90 days, my friends. $150, $4,000. And credit cash, $4,150. Represent the payment of that note within that 90 days. Sometimes there's a discount issued instead of a note, interest-bearing note. This is the opposite of a interest payment. It is a discount. What this is here's how it works. So the bank earlier, they gave us $4,000 for the loan that we took out, 15%, 90 days. Instead of the bank doing that, giving us the $4,000 up front, they'll give us $3,850. Okay. But we'll still pay them the $4,000 at the end of that 90 days. In other words, they gave us a discount instead of the interest attached that we pay later. Same concept, it's still interest. But instead of it being interest expense, it's a discount to the cash that you were given. So here's another example of this. Bank gave us a loan for $20,000, 90 days. They call it a discount note. 15% interest, 90 days, $20,000. It was the loan. So the bank gave us $19,250 in cash, and our interest expense was $750. So we debit cash, debit interest expense, credit notes payable $20,000. So that's when the bank gave us that cash. Now I got to pay the bank back. So I debit notes payable $20,000. I give the bank their cash back, $20,000. That's the payment of the note with the discount. That's how that works. So again, there's when it comes to loans, you have either interest attached to that loan, or you have a discount attached to that loan. It's not you got, when you hear the word discount, don't think of it from the consumer perspective. It's totally opposite. It's a discount, whereas they give you less cash up front instead of giving you the full principal balance. That's the way to think about it. Here's another concept. It's called the current portion of long-term debt. So your car, your house, your mortgage, these are all long-term notes. Long-term notes means you pay it more than 1 year. Okay. Example of that would be a mortgage or a car payment, auto payment. Those are long-term. You pay them typically over more than 1 year. But there's a current portion of that long-term note. The mortgage company still gets their money at the first of every single month. I don't just pay them in 12 months installments on long-term debt. No, it doesn't work that way. I pay them the current portion. The current portion of a long-term loan is that 12 within that first 12 months. That's the current portion of a long-term debt. Okay. And this is very, very typical, very typical. Another example of a current liability is a payroll liability. We accrue payroll expenses, and then we pay our employees later, right? That's a payroll liability. Related to that is payroll taxes, state and federal taxes, state and federal unemployment insurance expenses. These are all accrued in a current fashion. Installment notes, another form of current liability. Installment notes is a portion of the initial principal that we pay up front. And it's not as common, but they do happen. Issuance of when an installment note is issued, the entry, we debit cash, credit notes payable. We already learned about this, but here's another example of it. Principal amount, $24,000, interest rate, $6,000, term of the note, 5 years, annual payments, $5,698. When you initially receive that loan, you debit cash, credit notes payable. And of course, we're going to pay $5,698 over the course of 5 years until the interest and principal are paid in full. So at the end of each year, we make an adjusting entry. We debit interest expense to increase interest expense, debit notes payable to reduce the note payable, and credit cash. And then we make the same entry next year. You can see, however, the notes, the interest expense and note payable differs a little bit. And the reason for that difference is because, as you would expect, that the interest and principal balances change over time. Under the 5th year, interest expense a lot lower, notes payables higher. Oftentimes, we also call those balloon payments. And that at the end of when it's paid in full at the end of 5 years, the balance should be 0. Typically, you'll receive what is called a amortization schedule when it comes to those long-term notes. Another form of current liability is called a contingent liability. This happens from past transactions for events that occur in the future, plus likelihood of occurring, and what's the possibility of something occurring. When something is probable and estimable, we can reasonably assume that something will happen, and that causes what we call a contingent liability. An example of that would be warranty expenses. If you've ever taken advantage of a warranty, that means you bought something from a company. They said, hey, this is guaranteed by the company for 1 year or 2 years or whatever. If something happens to it, it breaks for mechanical reasons, it's under warranty. Yeah. There is a probable and estimable expectation that the company will indeed have to fulfill a warranty repair. Makes sense. So the company, just like we've done with bad debt expense, we estimate that will have to do a certain percentage of warranty repairs. So to do that, we debit warranty expense, credit product warranties payable. This is an example of that. And that happens from time to time. And along with that warranty, we debit warranties payable, credit supplies to replace a defective part under warranty. A lot of times you see that with auto manufacturers. Contingents are often disclosed in the notes. When something's reasonably possible, it's also disclosed in the notes to the financial statements. If something is considered to be remote, it means it might happen, but it's super rare. Okay, quick analysis for decision making, and then we're done. So, a couple of ratios. Just like our current assets, there's some ratios to determine feasibility. Does the company have enough current assets to generate cash? Can the company satisfy its current liabilities? Great. There are 3 ratios that we can calculate in order to determine if the company has the ability to pay its current debt, its current liabilities. First is called working capital. Second is called current ratio. The third is called the quick ratio. Working capital is very straightforward. It's current assets minus current liabilities. Very easy. Current assets minus current liabilities, that gives you working capital. Working capital basically says, hey, the company has enough of their current assets to satisfy their current liabilities, and what's left over is working capital. Makes perfect sense. The second ratio is called the quick ratio. It's where we take current assets divided by current liabilities. And that ratio tells us within reason what is the time frame that the company can pay back its current liabilities. And the third ratio is called the quick ratio. It tells us basically what is the instant ability of the company to repay its current liabilities. Quick, what do we take? Quick assets divided by current liabilities. You're probably wondering, Dr. B, what's quick asset? A quick asset is cash and cash equivalents. Cash and cash equivalents. Cash equivalents are things that can quickly be converted to cash. An example would be temporary investments and accounts receivable. And here's a nice example of that. Current assets, current liabilities. Current assets 9,180, current liabilities 5,400. Current assets divided by current liabilities gives you 1.7 for the current ratio. Working capital, current assets minus current liabilities is 3,780 of working capital. Quick ratio is 1.3. Oh, we got 1.3 cash plus your cash equivalents, which would be accounts receivable and investments divided by current liabilities. So 1.3 quick ratio. And with quick ratios, anything above 1 is considered good to pay. It's considered enough to pay its current liabilities. And that, my friends, is a conclusion of today's presentation. Are there any comments, questions, concerns that I can help to answer for you gentlemen, Dustin, Joe?
I had a question about why a company would sell a note to another company. I recently refinanced my mortgage,
Sure.
and they sold it off immediately, like before I'd even made the first payment.
Yeah,
why
very
might
common.
a company? Yeah. So why might a company do that?
Yeah, so there's a couple of reasons. Sometimes a company will sell a liability or a receivable because technically, Joe, when you think about it, on the bank's end, your mortgage is a note receivable to them, right? And sometimes a company will sell their receivables for a couple of reasons. One is they want to reduce their balance sheet to protect against liability. Another reason would be they are receiving some additional benefit for selling that asset. A reason for that might be they're receiving additional cash payment, or there's some type of relationship benefit. But typically when that happens, Joe, is that a bank will look at their overall balance sheet and what we call diversify their portfolio. And when that happens, that's fancy bank talk for, I'm going to reduce the possibility of default. I'm going to mitigate my risk by removing some of my accounts receivable that may become uncollectible over time. And so those are typically the reasons why a bank would do that.
Perfect. Thank you.
Hey, my pleasure. Good question. Dustin, are we okay? Did I bore you to death? He's probably eating dinner. Okay. Okay. So if we're okay, gentlemen, if there's no other questions, I'll conclude today's presentation. Just as a recap, what's going on this week? You got your week 5 discussion on your 10K project. This one's under fixed assets. Oh, I'm sorry. We're not in week 5. We're in week 4. Week 4, your discussion is on key reports and information. Always fun. You know what's fun with that one is when you look through your 10K reports, take a look at the management discussion and analysis. That area is always entertaining to read on a 10K report. Basically, it's management talking about the direction of the company, but those usually fun. I think you'll have your homework assignment and your weekly report. And that's it. Should be a pretty easy week, hopefully. Okay, if there's no other questions, comments, concerns, thank you, Joe and Justin, for taking the times out of your days to join me. Hopefully these sessions are helpful, and I look forward to our next one. In the meantime, if you ever have any comments, questions, or concerns, feel free to email me, call me, set up office hours, whatever it takes. And I thank you so very much for your time today, and I hope that you enjoy the rest of your day. Thank you so much.
Thank you, Dr. B.
Thanks, Joe. Take care. Thanks, Dustin. Take care.